Welcome to smarthelping.com. We've got another model here, general rental business, tangible goods. That means not real estate, like furniture, equipment. It could be heavy equipment. uh, so this is a 5-year model. We're going to go over each tab. I'm going to go over the assumptions and how it works. Uh, so here we go. Starting on the control tab, we have the main project assumption. So you're going to enter the start year. Enter 1-1 and then whatever the year is. Don't enter any other month or day. This is just to define the year, the date of the start year. Exit month. This will stop all operations, whatever month you pick, and based on that month, if you do choose the exit value or exit multiple, it's going to take the trailing 12-month revenue and multiply it by this multiple. If you do NA, then there is no exit value. This will affect cash flow. I also did a net exit value if you want to account for taxes and selling fees here. You can do that and get the net exit value, which will flow to cash flow. You can also figure out how you're going to fund the project. So obviously to start up a rental business, you got to buy a bunch of things and then you're going to rent them out. So you're going to need some money. This tells you if you have any bank loans or debt, you can put that as part of the financing. Any remaining cash needed will then fill into here, and that's going to be equity, and that would be investors or owners. You can enter some amount for investors and the percentage they get. The remaining cash requirement comes from the owners. Here's just some general breakdowns of debt and equity. We did drive down to income tax here and net income after taxes. So you can see corporate income tax will apply here. We also did dynamic depreciation because that's a very material line item for the rental business. You're buying stuff, it's going to have a useful life, and you can't expense the purchases right away. You have to take a depreciation expense. So that's all accounted for in the model, and the cash flow will not look at depreciation. It will look at the actual purchases per month. So we go to revenue assumptions. This is the meat and potatoes of the model. So if you're renting out things like it could be furniture or whatever, party supplies, equipment, you're gonna have purchase dates when you buy things, and you might not be doing them all at once. You might be scaling into it over time, depending on the cash available to invest in this and other things. So, depending on what your strategy is, this allows you to take averages of up to 25 categories of rental. And this could be like if you're renting equipment, it could be 25 different types of equipment, and you'd put in here the month of the purchase, the average cost per unit, and the number of units purchased. And based on that, you can do that for up to 7 rounds for each category. And that will all define how many units you have available to rent and the cost to purchase each of them over time, and as well as what the depreciation is on what's been purchased over time. Notice I said available units to be rented, so that's going to be different based on a few things. Number one, we have a utilization rate here that can be applied to each year independently. So this is saying of what you've purchased, what percentage of it can actually be rented out. So that's what this is. So if I bought 100 things and my utilization rate is 10%, then it's saying out of a full month, let's say 25 working days in a month, it'll take, what did I say, 100. So to take 10 units and assume you're able to rent out 10 units every day of that working month. And then based on an average fee per day for each of the categories, and multiply by that to get the revenue. The only difference, and here you can find the working days per month or define it. The only tricky thing here is I've done a monthly loss rate of units. So this is to say if you buy 10 units off the bat, in 5 years or 3 years, maybe some of those units have gotten broken or whatever, or you've lost some. They just wear and tear. So you can define a percentage that the units that you purchase deplete by. And if you don't want to account for that, you can just put 0% here. But if like here is 0.5%, so you can see in the one matrix, let's see which one. There's so much logic going on in here. It's so cool. Uh, let's see, where do we put the rentable percentages? Here we go. So this is remaining. So you can see there's that 0.5%. It's going down by 0.5 per month. So this is going to apply to the available rental units purchased for cohort 1, for purchase group 1. You can see how, because of this table here, to make it work, we have to do matrix tabs for each purchase group by category over time, because each one of these is a separate cohort. So you have up to 7 for each category, so that's 25 times 7. That's how many rows we got here to figure out what's actually available to be rented and the revenue from that. And we had to do the same thing with the depreciation schedules. So lots of logic here, lots of infrastructure. Excuse me. So then we have depreciation. It's just a useful life. That's going to define the percentage that it depreciates per month based on what you've bought and the cost of that. It'll go down over time, and you could change these for each category. And that's the main drivers of the model. Next up, you've got OpEx, which just is to define your expected costs, fixed monthly costs over the 5 years. You can pick the start date of the cost, define what the cost is and the amount. And this should be able to account for scaling and any other expenses that you think are relevant to the business. There's plenty of slots here. I also did a catch-all here where you can define up to 5 costs as a direct percentage of total monthly revenue, and that will just flow in based on the start months here. And yeah, these are considered G&A, but right now, or in the model, we just accounted for them separately right here. And because they could be cost of goods sold, it really depends on what it is. It's designed to help with modeling quickly and efficiently, just like a catch-all expense line. You could obviously zero all this out if it's not applicable. We have one-time startup costs that you can account for and future one-time expenses out. Obviously, this is all outside of the furniture purchases. This is like, office renovations for your business or whatever. If you want to account for essentially cash flow flowing out at some month in the future, that's not already accounted for elsewhere. Then we have the monthly P&L detail. So this is going to list all your purchases over time, how many you purchased, the total cost of those purchases each month, very important for the cash flow, monthly cash flow, and then your cumulative purchase amount. Then you can see here's the rentable units by category, is summing up the total based on all those assumptions. And then you've actually got units fully rented out. So this is going to apply, so this number is going to apply to the utilization percentages to get this number. And then that number is used to figure out the monthly revenue per category based on all the different purchases for each category over time. Then you got total revenue, you've got average monthly rental revenue per available unit and per unit rented. So this number is just based on uh, these numbers here. But this top number is based on essentially, this is showing the drag of unused or unutilized inventory. So if you buy things and they aren't rented out, well, they're still essentially, this is saying what your average revenue is per unit if you're applying whatever revenue you get to all units, no matter what the utilization rate is. So this difference is essentially showing you occupancy versus full potential. So this would be full if you had every unit 100% utilized, and this is what you're actually getting based on purchased units. And that will all be dynamic based on your assumptions entered. Just OpEx, G&A, R&D. These are all the fixed costs. Here's your catch-all percentage of revenue. We've got total operating expenses. We've got EBITDA here. Then we've got debt service. financing from debt if applicable, debt repayment, which will happen automatically on the exit month if there is an exit month, and the debt balance over time. Then we've got depreciation expense, which is another dynamic figure. And then we've got earnings before taxes, which is taking the essentially EBITDA minus interest minus depreciation. Then we got a tax rate that's going to apply if it's a positive. If earnings before taxes are positive, it's going to apply a rate to that number and then populate into here for that year all the way over. And then you've got your net income, profit margins. Here's your startup cost, capex, terminal value, which you can see in the last month. The net terminal value, you can see that the net is what's used in the cash flow. Cumulative cash flow over time, cumulative cash flow after equity, which is where you're going to see the zero out and balance, because this is saying this is the minimum equity you need so that you don't go in negative cash position on a monthly basis. Net book value is taking the total value of purchases minus the total accumulated depreciation. And these are just helper rules to figure out the active months and for trailing 12 months revenue. Annual P&L does the same exact thing as what I just went over, but just on an annual basis. Distributions, these will show what your cash flows available to distribute are versus what's required, any negative cash flow months here. And then based on starting equity, it shows what the total equity requirement is versus what's returned over time. And you can see on the project level, the IRR and discounted cash flow analysis, as well as on an investor and owner cash flow basis. I put a chart here to see the cash flows for investor versus owner over time. Executive summary does the project level financial forecast results for the key line items, so revenue, main cost items, EBITDA, net income, so you can kind of see everything in one shot here with some visuals. And then here's a summary of the project for equity, return, multiples, ROI for investor, owner, and the project. Visualizations, definitely some cool stuff here. So we did, revenue and EBITDA, which are the bars, against the total purchased units and the versus total purchased units and cumulative rentable units. So this is showing you that percentage that's defined in the revenue right here. This percentage, the effect of that is the difference between these two lines. So this is your total that you bought. This is actually what's rentable, not what's actually rented. If you go based on your utilization rate, then you'll get to total rentable units by category. Total actual units rented by category down here. So you can see this is like a little bit over 3,000. Your actual available units to rent is 36 or 700 here. And you can see this is the purchases versus what's rentable. So this 3,600, this bottom line is what's available to rent, which would be this. And then this is what's actually rented. Rentable units by category, actual rent, revenue by category, stack column, also revenue by category percentage, so you can see what categories are making up the most revenue based on your assumptions. Also expenses by category and expenses by category percentage of total. Average rental revenue per month. Now this is interesting. Available to rent versus rented. So this is that what I talked about up here, where you have what you're making if you have account for all your units that you have available against what's actually rented, and then this number would be if you rent out 100%. This is your average revenue per unit rented. So that difference is again specified or shown here very clearly, and that gap is your utilization percentage difference. We have monthly cash flow and accumulated cash over time of the project. This is before any equity is put in. Monthly cash flow, same thing is essentially this is showing. Let's see if we take out the exit, you can see a little bit better. This is like the actual monthly cash flow. Net book value of total purchase units over time. So again, this is total purchases less depreciation, and then EBITDA per month. Let me set this back to the last month of the year. And that's the model. This is just a standard amortization schedule, and then all the matrix tabs. You'll see this in depth. I did three. It took me 3 weeks to build the model, and I did live videos on the whole thing from start to finish. I just finished it today actually, and um, that goes more into depth on building all these matrix and depreciation schedules and trying to make everything balance out. All right, that's all I got for you. This model's actually only going to be $45. I think it's a really fair deal. And if you do purchase it, you'll receive it right after your purchase. And I will be posting it on all the different vendor sites that I am partnered with as well. All right, I'll see you guys on the next one.